The broadcast is now starting. All attendees are in listen-only mode.
Good morning, good afternoon, and good evening, everyone. Thanks for your patiently waiting. Today with us is our tanker shipping senior analysts, Anshika and Caroline, and myself. Drewry is providing research and advisory service in the shipping markets. In terms of advisory, we have been provide expert service to financial institutions, ship owners, charters, and other parties in different perspectives. We are covering all the shipping sectors, as well as in terms of the areas, apart from the market outlook and forecasts, ESG, freight benchmarking, we're also covering due diligence and shipping strategy from different perspectives. So now I would like to showcase one project we did for a client. In Southeast Asia, which in this project we had supported clients to make analytics for their shipping tonnage requirements and rationalized the recommended fleet composition, fleet development, as well as contract strategy for their shipping clients. So without due delays, let me pass over the floor to my colleague, Anshika. Anshika, would you please share with us some high-level key drivers that's impacting tanker markets at current geopolitical developments? Over to you, Anshika.
Sure, Serena. Thank you so much. And okay, I'll quickly start with the key drivers which will impact the tanker market this year. I'll first start with the supply and demand fundamentals. And yes, so because of a strong order book in both crude and product tanker market, because of a high ordering in 2023 and 2024, we expect the fleet growth to surge this year. However, if I talk about the crude tanker market, it still has a low order book as compared to product tanker. And if I again talk about the specific vessel segment, then we expect VLCCs to outshine as compared to its other counterpart. This is because of mainly two reasons. First is only a handful of VLCC deliveries are scheduled to deliver this year. Only 5 VLCCs will be delivered in 2025. And secondly, a rise in long-haul trade from Americas to Asia because of surge in Asian refinery runs. And thus, all of this will support the VLCC demand this year. However, if I talk about the product tanker segment, both MR and LR has plenty of orders in its order book, and it will increase the tonnage supply. It will surge the supply, and it will weigh on the charter rates. Talking about the demand growth, we expect the demand growth will remain subdued this year, as the refined product seaborne trade is only expected to rise by 0.4%, whereas for crude it will inch up, it will rise by 0.9% in 2025. We expect the oil demand to slow after 2025. And talking about the two major refined products, gasoline and diesel, which combinedly constitute around 80% of total CPP demand, is expected to see a slowdown in its growth rate, which is because of a rise in EV sales and a switch towards cleaner fuel. And thus, the tonnage supply will outpace the tonnage demand growth, and which will negatively impact the charter rate this year. The other factor which is impacting the tanker market is the Red Sea crisis, which is supporting the ton-mile demand in 2025. as tankers are still taking the long-haul route via Cape of Good Hope, and almost 60% of tanker traffic is still passing through Cape of Good Hope. We expect the ton-mile demand growth to remain supported by this in 2025, as there are no peace talks in the site as of now. The last but not the least, the Iran-Israel conflict, which has recently emerged, and it has shaken the tanker market into, and it will, it will be very disastrous in 2025 if what people are talking about and what Iran is threatening to close Strait of Hormuz, it will be of a major concern in tanker market. And we'll also cover Iran-Israel conflict in detail in our slides later.
Okay, so fundamentally, the freight market looks a little bit gloomy, except for the upcoming developments in the geopolitical sides, which added a bit of thoughts into it, which could make the spike up the freight rate in the shorter term then. Okay, now if we may hand over the floor to Carolyne to talk about the fundamentals of the oil demand and supply. Over to you, Carolyne.
Yeah, thank you, Serena. Just a moment. Yeah, so to start off, let's look into the oil demand prospects. Our forecasts for oil demand growth in 2025 have been revised to 0.7% from 1.1% due to changes in the geopolitical landscape and escalating trade tensions. Although we had expected the macroeconomic conditions to improve at the start of the year, the various geopolitical developments have caused things to play out differently, and the persistent trade war also further negatively impacted our forecasts, which resulted in us lowering our expectations in growth, oil demand growth this year. The largest share of oil demand growth is expected to come from non-OECD countries, where China will lead the growth. China's refinery operations are set to expand by 300,000 barrels per day this year. However, the ongoing trade war, the sanctions on teapot refineries, and weak economic indicators are likely to hamper China's oil demand and limit the overall boost in refinery throughput. Meanwhile, the westward flows of crude will continue to fall in 2025 due to weak refinery runs in Europe and the US, an uptick in refinery runs in Latin America, and Mexico will curb the exports of refined products from the US this year, reducing refinery runs and thereby curbing the US crude oil imports for the year. Oil demand growth will continue decelerating in the forecast period due to increased fuel efficiency and shift towards cleaner fuels and EV. China, which had been the forerunner of non-OECD oil demand, is likely to hit its peak earlier than other countries because the penetration of EVs in the country is really high. Coming on to the trade war between US and China, the import of oil and refined products was exempt from the US tariff for most countries. So any retaliatory measures and trade disputes will affect oil demand, but just indirectly. However, the rising US tariffs and China's retaliatory tariffs will nonetheless eliminate any crude flows between the two countries. Now, moving on to the supply side of the story, the global crude oil supply is expected to increase by 1 million barrels per day in 2025. The production of non-OPEC plus countries, especially the US, is expected to increase by 300,000 barrels per day this year. Higher crude output in Latin American countries like Brazil, Guyana, and Argentina will support Latin America's exports. Nonetheless, an uptick in refinery runs in the region, especially in Brazil, and the likely decline of oil supply from Venezuela due to the US sanctions will cap the overall export growth potential for the region. And moving towards North America, US crude exports are expected to rebound this year due to domestic production increasing and refinery runs slowing down. However, weak oil prices will remain a threat to US production, which could contract anytime prices fall below the benchmark $68. Meanwhile, Canada's seaborne crude exports will increase due to higher oil production, while Mexico's crude exports are set to decline because of reduced domestic production and increased refinery runs. Africa's crude exports will also decline in 2025 due to increased refinery runs and an uptick in crude production. Even though the crude production will rise, its exports are expected to decline, as most of the production growth will be coming from Latin America and North America. Long-haul trade is expected to increase this year, but in light of the recent OPEC Plus unwinding of the voluntary supply cuts, we expect an increase in exports from the Middle East, despite the region increasing its refinery runs. So on to the OPEC Plus production. After the series of production cuts and extensions which have been in place since October of 2022, OPEC finally decided to unwind 2.2 million barrels per day production cut it had implemented back in November 2023, starting from 1st of April. This move is pretty much bound to result in adding more barrels to the already oversupplied oil market. However, the cartel members exceeding their production limits must reduce their output to compensate. So as a result, although the cartel has been trying to increase their production and even accelerating it between May and July, the actual production has been much lower because countries like Kazakhstan and Iraq, which have been overproducing, are being forced to compensate for their past overproduction. But a point to note here is that even if the cartel maintained the voluntary production cuts, that is, even without the unwinding process at the moment, the market would still be oversupplied because the non-OPEC Plus production isn't expected to increase this year. Now, the OPEC Plus decision to unwind came at a time when the market was already oversupplied and prices were falling. And though initially prices did continue to fall after the initial unwinding process, the recent developments in the Middle East have pushed up oil prices. Now, if we consider a scenario where the crude flows from the Strait of Hormuz do not change, then if the unwinding is successfully completed within this year, it will put pressure on oil prices, obviously, and as a result of the oversupply, most of the brunt is expected to be faced by US producers who had been planning to increase their production this year, and because of lower prices, they would have to cut on their production. Now, if we look at the chart on the top left, which is a demand-supply balance, the gap between the oil demand and oil supply is very much clear, but even with the OPEC unwinding at hand, if producers like Kazakhstan and Iraq continue to overproduce, then this gap between the demand and supply will increase much further in the subsequent quarters. The lower oil prices, which will result from increased oil supply, will allow for more inventory restocking, which in turn will result in higher oil trade despite the weakening oil demand, because Middle East supplies will increase despite increased refinery runs, and this will help boost the demand for VLCCs in the Arabian Gulf, which will keep the rates for this segment attractive for the remainder of the year.
Okay, thanks, Caroline, for the detailed explain. So basically, we would say there are likely oversupply condition in 2025, and the inventory stocking will be increased. It will be start to piling up, and which will put the pressure on oil price. Okay, moving on, as we have seen the current conflicts between Iran and Iraq, and Iran threatening to close the Strait of Hormuz. So Anshika, would you please elaborate on the impacts these developments will cause to the current crude tanker markets?
Yes, sure, Serena. Yes. Okay, so I'll first start with the significance of the small passage Strait of Hormuz in global oil trade. And this narrow passage actually connects the major exporter in the world for crude oil, that is Middle East region, to the global market. And all the key OPEC producers, that is Saudi Arabia, UAE, Iraq, Iran, they all rely on this small passage for their crude oil exports. And although crude exports through Strait of Hormuz have declined in recent years, mainly because of two reasons. The first is OPEC produces voluntary cut, and the other is rising non-OPEC supply. But this passage still accounts for 34% of global seaborne crude oil trade, which is passing through Strait of Hormuz. And for refined product trade, it accounts for 17% of global trade, which shows that this passage is very critical for global oil market. And most of the crude oil trade which happens through this passage is destined towards Asia Pacific, with China, India, and Japan being the largest importer. Thus, and after Israel attacked Iran on 13th of June, the oil prices jumped and surpassed $70 per day prices, and earlier this the prices were ranging between $65 to $67 per barrel. Okay, so I'll talk about the current situation of Strait of Hormuz, and this chart is basically from Drewry AIS, and the second snapshot is taken yesterday from Drewry AIS, in which we can see that the traffic remains at a normal level, which means that ship owners are not actually avoiding Strait of Hormuz as of now, and the traffic remains normal. However, as Iran has threatened to close Strait of Hormuz, there are no viable alternative to bypass Strait of Hormuz. However, there are east and west pipeline in Saudi Arabia, and there are pipeline in UAE also, but it won't be sufficient to create a balance in the global oil market. Almost 15 million barrel per day of crude oil passes through Strait of Hormuz, and out of which only 4 million barrel per day can be diverted through these pipelines, which means in case of full closure of Strait of Hormuz, 11 million barrel per day of crude oil will be out of the market, and which will be very disastrous for crude oil market. Thus, we can, according to Drewry, we don't think a full closure will be very much likely, as China is the major importer of Iranian crude oil, and in case of full closure, Iran will be at a loss as its own revenue will fall, and China can easily source oil from elsewhere, maybe from non-OPEC producers from Brazil. Thus, we don't expect a full closure of Strait of Hormuz. However, a partial closure cannot be ruled out. And in case of partial closure, we expect that the insurance premium, war risk premium, and operating costs will sky high, and it will lead to a vessel repositioning and a shift in trade pattern of crude oil market, which will increase the tonnage demand of both crude and product tanker market. Also, with today's retaliatory attack, we have seen that the war risk premium for shipment to Israel have already increased to 3 times, which shows the very increase in volatility in the market and increase of risk in the market. So yeah, this is all from my side. Thank you. Oh, sorry. Yeah, in order to summarize our webinar. So on the demand side, we have expected a modest oil demand growth. We have seen that the seaborne trade of both crude oil and product tanker market will remain subdued in 2025. On the other hand, if we look at the supply side, the product tanker fleet growth will surge in 2025. However, if we compare it with the crude tanker market, it will grow a relatively slower, at least in 2025. And thus, we expect that the crude tanker market has a better prospect than product tanker market. As a result, as I have already talked about this, that we expect tonnage supply to outpace the tonnage demand. This will impact negatively on the charter rate, and thus we expect the vessel earning to fall this year. However, there are two major wildcards this year, which is Iran and Israel conflict and the Red Sea crisis. Both can impact the market, and it will change the fundamental of tanker market. It can lead to a short-term increase, a spike in charter rate if actually Strait of Hormuz is disrupted by Iran, and in case of Red Sea crisis, if actually ceasefire talks and if Red Sea crisis has actually eased and tankers have started taking Suez Canal route, it will again be negative for ton-mile demand growth. Yeah, that's all. Thank you.
Thanks, Anshika and Caroline, for your detailed explanation on the market and on the geopolitical developments. So let me pick some questions from our Q&A panel. Okay, so we have this question. I think, Anshika, maybe this question is to you. So what do you think about the VLCC markets in 2027 and beyond? What would be the market rates going up or down? Can you elaborate?
Yes, sure, Serena. So actually in 2025, there are only 5 VLCCs which are scheduled to deliver. However, in 2026, the numbers increase to 30, and in 2027, we expect 46 tankers to join the fleet. However, VLCCs will see very low deliveries this year, but from 2026 and 2027, it will improve. And thus, we expect that VLCCs could perform better this year. However, from 2026 and 2027, in coming years, VLCCs will also have a fall in the earnings, because if you look at the demand side, it is not very rosy for VLCCs, as the oil demand growth is set to slow down. And thus, on the other hand, the tonnage supply, as I've already talked about, the vessel deliveries will rise after 2025. Thus, it would not bode well for VLCCs after 2025.
Okay. Maybe a second question is that as we discussed about the disruption or potential disruption of Strait of Hormuz, as we know now, the Red Sea side also have some impact, the disruptions. So will there be a multiplicative impacts if both are disrupted?
Yeah. I have already talked about this, that almost 15 million barrel per day of crude oil is passing through Strait of Hormuz, and out of which only 4 million barrel per day can be diverted through these pipeline, where I think Saudi also has 2 pipeline and UAE also has 1 pipeline. And thus, even after 4 million barrel of crude oil which can be diverted, we are left with 11 million barrel per day of crude oil, which will be out of the market, and it will lead to an oil deficit, as Middle East is the major exporter and producer of crude oil in the world, and thus the market will suffer and the oil deficit will definitely happen.
Okay, thanks for your explanation. That is clear. I think we have covered all the questions in our Q&A panel. Do we have any other questions, anyone? Or else we will proceed to close our webinar today. Thank you everyone for attending the webinar, and and thanks for patiently waiting at the beginning. Have a nice day ahead. Bye-bye.
Thank you. Bye-bye.